I'm going to take a few minutes to go over the proper use of the payment and payment methods in using ProfitNet. Now, with any management system, it's extremely similar as how you would utilize the payment methods, but with some management systems, they don't have the sophistication to be able to send certain types of transactions into QuickBooks. However, ProfitNet does a good job of being able to allow this. So let's just take a look at it, and I'm going to explain the different payment types and what they're used for. We click onto the Payments tab when you're getting ready to receive money from the customer. And the one that's important here is the methods. And when we double click the methods, we've got the standard ones that you are aware of. If the person's using an American Express, and please excuse the video resolution, it may go in and out because of the transmission over from a remote control connection. We got American Express as a credit card, and it goes over to the undeposited funds screen, which is $12.25 in QuickBooks, and it's ready for deposit by a batch or whatever is going to be bringing it into QuickBooks. Cash is the same way. You have the option at that point to be able to deposit into the petty cash or into the bank account with a regular deposit. I'm just going to go over the basic ones first, and then we'll come back to the ones that are unique or different. If they're paying by a check, whether it's an insurance check or whether it's a customer check, you'd be used for the check. The cleanup, and I'm going to inactivate this afterwards after we make sure everything's cleaned up. This is not to be used once the system has been validated as far as being reconciled to the right amount of accounts receivable. The rest of these right here are collections and contra we're going to look at separately. Coupon, if it's a debit card, the customer uses the debit card, uses the debit card. If it's a Discover card, MasterCard, money order, all of those are basically the common ones that you would use. Visa is another one. Okay, so let's go up to the beginning again and let's look at some of these ones that are new. For instance, customer goodwill. You would use customer goodwill if, in fact, let's say the job was $1,500 and the customer was unhappy with something, and you're going to knock off $100 for them because you want to satisfy them and that they are accepting the $100 deduction or deduction off of what they owe. Now, this is not the same thing as if you were going to not replace a part on an automobile and they want to keep the money, or like for instance if they have a wheel on the estimate and they'll still take care of it. That is not customer goodwill. This is strictly to be able to please the customer, and you're not going to get all the money as a result of that. So that's what customer goodwill is used for, and it is tracked in QuickBooks in the appropriate account automatically. If we go down to collections, this one is used in case you have a balance due and you are planning to go after them either with an attorney or you to go to small claims court. Then you would use this and it will send it over into a asset account to be ready in case you do collect. And if you don't collect, we ultimately write it off out of collections into a bad debt. Or if you actually have fees associated to the collection, we write that off as well, and then assign the collection to other income. So it is designed to handle this automated. It doesn't go into QuickBooks and then deposited funds. It automatically does the transaction to it. If we get to contra or bartering, the reason I use the word contra is most audits look for that term bartering, and so we don't usually call it bartering for that reason. Bartering is if you work with a company, another company of some sort that you're doing work with and you're going to trade it off for something that you're going to get in replace of it. So for instance, if you're working out with an electrical contractor, you fix their car and they're going to do some work for you. This keeps a great track of that. Now, if this is going to be a common scenario, we will talk a little bit about in the QuickBooks how to manage it even better in QuickBooks, but this is the initial. So if, for instance, you did a car for somebody, ABC Construction, and it's for $1,000. So you receive a payment for $1,000 under contra for this, so the balance will end up being zero, but it will send it over into the contra account showing that you have $1,000 owed to you in the contra section. Now, whatever they do for you, you pay the bill out of that account. So let's say, for instance, you did $1,000 worth of work on their vehicle, and they did $600 worth of construction work in your office. What that will show is that there's a balance due to you for $400. And we'll talk a little bit more about making sure that you are the one that submits the bill secondary instead of first. But all in all, this takes care of it and manages it very well. And if at the end it boils down that the $400 they owe you, then you have the documentation there is that they owe you the $400, and then they pay it, and you're back square again. Coupons are used if, for instance, you do come out with some type of coupon, a deductible assistance card, or some kind of special discount for some kind of something that you've advertised. This would be that amount. So if it was $100 off, the coupon would be used in $100, and it would track how many of those are happening automatically in the background. The gift card would be a similar thing, except most people don't realize that if somebody came into your facility and wanted to buy a gift card for something, and let's say, for instance, you do detailing as well, and someone buys a detailing for $250 for their son. Well, when you actually give them the gift card, that is actually a liability to your account until you actually perform the service. So this will automatically go into that account and be there available when it's time to do the actual work. And that process is handled in the background, because if this is actually, you would use this when they're getting the work done. So let's say they had a $250 detailing done and there's not going to be any payment because they'd already bought a gift card, then you would actually put the gift card in for the $250. And when you sold them the gift card in QuickBooks, it would have already put in the $250, so it would have washed it out to balanced. Of course, MasterCard, money order, we've already talked a little bit about. Now, overpayment keep. Now, this, you have to understand that this is if by accident that the job actually totals for $1,500, and the insurance company, for whatever reason, sends you $1,530. Well, you got $30 extra. Well, when you have that situation, you have to use this as a payment method, but the amount that you're going to put in there is going to be a negative amount, because you're going to have to move the $1,530, which is going to show an overpayment of $30. If the job was only $1,500, you'll have to put it in as negative $30 as an overpayment. And when you do that, it automatically takes care of it in QuickBooks and puts it in as some additional other income because you really didn't earn it on that particular job. Refund overpayment. So now we've got a overpayment scenario, and you've basically are going to give them the money back. Now, this is what's important here, is that it's also going to be a negative number. It's going to be, let's say, for instance, the job is $1,500, included a wheel for $100, and they didn't want the wheel. Now, that job needs to be changed so it shows that the job is only $1,400, not $1,500 with the wheel, because you didn't do the wheel. Now, what you do is you delete that line. You do make a note in the repair order that the customer wants to take care of the wheel themselves, and you're refunding them the $100. So in essence, if the insurance company paid the $1,500 and the job now says $1,400, it's going to end up being a negative $100 or an overpayment of $100. So you put the refund overpayment in as a negative $100. Now, what this is going to do is it's going to set up an entry right in your check register in QuickBooks. Now, you can't actually print this out as a check because it's going to come in as a journal entry, unfortunately. But it is a placeholder. then you just write the check right below it for that amount, all the information that is in the journal entry you need to have in the check. In other words, it's going to have the business receivable and the customer's job and job number and the amount of $100. And once you print the check out or give them the check or handwrite the check, then you just delete this line item out of QuickBooks because it's just a placeholder so you don't forget it. Now, another one that happens every once in a while is you get a returned check or a stop payment check. Sometimes a vehicle insurance companies write a check for $5,000 or $6,000. Then the car gets into process and then they decide to total it. And then sometimes instead of them letting you just give them the check back or write them a check, they stop payment on the check. When that happens, you enter this in as a negative number, and it will then basically add it back to the balance due or remove it. So now if you've got a repair order that's, let's say, $5,000 and then it's going to end up being a total loss, you delete the lines, and now your ultimate cost or your charges are your dismantling, your towing and charges and those type of things. And let's say it only comes out to $2,000. Well, they've already written a check for $5,000. You've already received that check. Now you have to put it in as a negative $5,000. So now it's only going to show the $2,000 owed because you deleted all the lines. This automatically goes into QuickBooks and removes that returned or stop payment check out of your checking account, so that when you look at the bank, it's actually going to take it out automatically anyway. It's already there for you, and it takes care of it for you. Now, the one that's used quite a bit is short pay. Now, short pay is you're just not going to get the amount of money that you thought you were going to get when you close the job. Every repair order should be closed as soon as the taillights leave the parking lot. And yes, there may be times where you've written a supplement. The company that's going to be paying the bill or the supplement has a different system, and there's going to be a system differences or whatever the thing is going to be, and it's probably likely that it's going to be less than what your job is. But there is no reason to keep the repair order open. There is no reason to try to balance the repair order to what the insurance company says. All you have to do is make the difference as a short pay. So if your job again was $1,500 and the insurance company comes back with $1,450, and you're not going to go after that $50, it's not an accounts receivable, then you receive the $50 as a short pay. It zeroes out the accounts receivable. It also reduces it off the revenue in QuickBooks as a revenue adjustment, and it also keeps track of how many times this happens to you. So that's how a short pay is used. And it is only used pretty much if a customer short pays you, doesn't pay you $40, or if the insurance company short pays you. That's the only time it's used for. Transfer to another RO and transfer from another RO. This does this in the background. There's times where you might have some extra money in one RO that they want you to apply to another RO. So in the case of, let's say a wheel wasn't replaced and there's $100, so it's going to be a negative 100 is going to basically take this money, put it in a liability account until the next RO is done, and then you can bring that back in and take that money and use it for another RO. This kind of cleans things up a lot easier than trying to handle it any other way. So the first RO, you're going to transfer the negative $100 to the 2150 account for that particular vehicle or that customer. And then when the other job is done, if that extra $100, you just have to transfer it from another RO. And in the notes, you put what RO it came from, and then that $100 then comes back out of that account, and that account should zero out. The other one to talk a little bit about is warranty. Now, if you're redoing a job, this is not a paint warranty that you're going to be getting reimbursed. That's not how that's handled. We can talk about that also, because those are actually jobs that are in accounts receivable until your paint vendor is going to either give you the credit or the check for that. That's also the same thing's true if you're fixing parts, OEM parts, or LKQ parts. That's not the warranty part here. Warranty is you've got a job that you're redoing and you're keeping track of the cost that it takes for you to redo that job. And this will actually put this into a warranty account under revenue adjustments. So how you want to handle that, whether you want to actually discount your labor and discount your parts, typically we take the cost price of your parts and we take some kind of adjustment for your labor, although it doesn't really make that much difference as if you're just going to run it as a full retail job as well. Do not use is do not use. Now, fleet work or provider discount. This final one that we have on here, in essence, if you're doing some fleet work, they always want to take a bottom line discount. Same thing as what some of the providers are doing now across the country. And that's all this is. If you're going to, for instance, $1,500 and Wheels wants to take 15% off of that, that's going to be $750 that they're going to write a check less than what the balance was due. Should be $1,500 to be $75. No, 15% of $1,500 would be $225. So $225 you will be short. It's not a short pay. It's the discount you gave them because you wanted to get that type of fleet account. And so you'd have a payment of $150 or $225 in this case that would go to the revenue adjustment account of fleet work and provider discount. You could use this if you're just discounting it to a customer. If, for instance, you're wanting to give them a 10% discount because they're a veteran. There are some other ways that we can add some payments if you're doing anything that's such as that. What you want to make sure you do is keep your accounts receivable in sync with QuickBooks. So it's important that almost always your payments start in your management system and they transfer over to QuickBooks. And at the end of each month, we want to check to make sure that our accounts receivable are in sync. And this keeps that straight by using these payment types.